Active investing or passive investing, which one actually builds more wealth? For decades, investors have argued over this question. One side believes beating the market is the fastest path to wealth. The other says trying to beat the market is one of the biggest investing mistakes you can make. So, who's right? Before we get started, make sure to like this video, subscribe to the channel, and turn on the bell notification so you never miss any of our future videos. The answer isn't based on opinions. It's backed by decades of research, real-world results, and one famous $1 million bet that completely changed how many people invest. Let's start with active investing. Active investing is all about trying to outperform the market. Instead of buying hundreds of companies through an index fund, you choose individual stocks, sectors, or actively managed funds that you believe will generate higher returns. Sounds simple, right? But here's what most people don't realize. Picking a great company is only the first step. You also have to buy it at the right price, hold it through market crashes, and avoid selling when fear takes over. That's much harder than it sounds. In fact, research from Dalbar has repeatedly shown that many investors don't lose because they pick bad companies, they lose because emotions lead them to make bad decisions. They buy when prices are high because everyone is excited, and they sell when markets crash because they're afraid. In other words, the biggest risk isn't always the market, it's investor behavior. That doesn't mean active investing is a bad strategy. If you have the time to research businesses, understand financial statements, and stay disciplined during market ups and downs, active investing can outperform. That's how investors like Warren Buffett built their reputation. By finding great businesses and holding them for years. But there's another challenge many beginners ignore. Most actively managed funds charge much higher fees than index funds. A 1% annual fee may not sound like much, but over decades, that small difference can quietly reduce thousands of dollars from your portfolio because of lost compounding. So if active investing offers the chance for higher returns, why do so many experts still recommend passive investing instead? The answer becomes much clearer when we look at what decades of real-world data actually reveal. Passive investing takes a completely different approach. Rather than trying to predict tomorrow's winners, they invest in low-cost index funds or ETFs that track markets like the S&P 500. As businesses grow over time, their investment grows too. It may sound less exciting, but history tells a powerful story. According to the SPIVA scorecard, the majority of actively managed funds fail to outperform their benchmark over long periods after fees. Even professional fund managers with research teams and advanced tools struggle to consistently beat the market. And the evidence doesn't stop there. In 2008, legendary investor Warren Buffett made $1 million bet. He challenged a group of hedge funds to compete against a simple S&P 500 index fund over 10 years. Many expected the professionals to win. They didn't. The low-cost index fund delivered better long-term returns after fees, proving that keeping investing simple can often be more effective than constantly chasing the next winning stock. Morningstar research points to a similar conclusion. One of the strongest predictors of a fund's future success isn't a famous manager or a complicated strategy. It's low costs. The less investors pay in fees, the more money stays invested and continues compounding year after year. Does that mean active investing is useless? Not at all. If you genuinely enjoy researching companies, understand business fundamentals, and can stay disciplined during market swings, active investing can still be rewarding. But the reality is that it requires time, experience, and emotional control, qualities many investors underestimate. For most people, passive investing offers a simpler path. It provides broad diversification, lower costs, less stress, and a strategy that's easier to stick with during both bull and bear markets. Here's the biggest lesson. Successful investing isn't about making the perfect prediction. It's about following a strategy you can stick to for decades. Because wealth isn't usually built by finding one magical stock. It's built through consistent investing, controlling emotions, minimizing costs, and allowing compounding to work its magic. So before choosing between active and passive investing, ask yourself one question. Are you trying to beat the market, or are you trying to give yourself the highest probability of building long-term wealth? Your answer may have a bigger impact on your financial future than any single investment you'll ever make. If you find this video helpful, do not forget to like the video, subscribe to the channel, and press the bell icon so you don't miss any future videos. Thanks for watching, and we will see you in the next video.